Yes, as Dmitry pointed out, I'll be talking about jumps again. And this will very much be based on option data, this work here. So this is a joint work with Tim Bollerslev from Duke, who I believe should be in the audience too. And it's about jumps. And so let me try to briefly motivate what we are after here and why we are writing this paper. So maybe like more than 10 years ago, I think by now, we wrote a paper on tails and fears, which was basically trying to separate or tease out the contribution of jumps into variance risk premium, into the variance risk premium, which people were studying a lot at the time. And the main finding basically there was that jumps contribute a lot to this to the risk premium. Now, this, however, on some level is kind of puzzling, because if you look at the typical, now we have high frequency returns, and we can actually have a very precise measure of the jumps. We don't need to just model them parametrically. We can just go in and pretty much identify the jumps, pin down the jumps, but going at a minute level, or even some people go at second level data these days. And then when you look at this, when you look and identify these jumps, you see that actually their size is kind of small, and you rarely see a jump more than 0.5%. The typical jump size is much smaller. And so that is puzzling then why such jumps like this, price jumps, can generate such a big pricing effect, have such a big pricing effect on the level of out of the money, deep out of the money put prices. And just to just to give an idea of what we mean, and there are many ways in which you can quantify or assess that kind of this, well, maybe we can call it a puzzle, this puzzling high level of compensation required for jump risk. So one way to just quote this, which I will do, and which I think is particularly useful and easy, is if you go and look in the estimated model-free techniques, estimate the way the out of the money option prices, short dated, decay on the left side, on the left tail, basically out of the money puts, and then you estimate the empirical, look at the empirical distribution of jumps and look at the way these tails decay on the P, then you will see a big gap between this Q tail decay and the P tail decay. And the reason why I use this way kind of to measure the distance between the P and Q distribution of the jumps is because if you work with a standard model, like say with rare disasters and agents with Aston-Zinn preferences, then these differences in the tails, in the tail decay parameters, is exactly the risk aversion, okay, of the representative agent. And so if you look at this from that point of view, you will need probably, if you go and estimate these measures, again, this tail decays non-parametrically, you will find something like you need a risk aversion of, well, roughly of 200, or maybe, well, around 200, which is really crazy, kind of a crazy number. Okay. Now, of course, you know, like, we are not the first to point this out. I mean, there have been others who have been showing and estimating, and jumps seems to be puzzlingly highly priced by investors. So then you kind of think, why should, again, so that looks puzzling, and you're asking yourself, why is this the case? But then if you look at the high frequency financial data, return data, then of course you notice, then you have probably noticed that jumps don't arrive alone. And here's an illustration of this. I think plots are much easier to convey these messages. So I looked at one episode in the data, in the recent data, when we had over a week, more than a 10% loss on the market, in the market index. So I'm using here the spider for that. So this is the left panel here. You see the SPY, or the spider on the spider on the ETF on the S&P 500 index, and I look over that week. I zoom in and look at that week when the market really, if you look at the weekly return, was more than 10% down. Okay, and what you see on this left plot is that yes, there were jumps, and in particular this intraday jump here, overnight jump, which looks big. If I had high frequency data, if I was using S&P 500 futures, even that jump will not really look that big, but they are relatively small, and there's a sequence of those jumps. Now, the other thing which you can probably also kind of eyeball econometrics do, look at that actually the jumps are accompanied also by increased level of volatility. And so to kind of highlight that feature of the data, so on the right panel, what we do is we went and calculated for the week of the extreme event, which is called week 0, the realized volatility. Okay, and then we also looked at the behavior of the realized volatility before, the weeks before and after this event. And not so that what you see here is this black solid line here is that realized volatility. Well, not surprisingly, because of the way we are conditioning, the peak is at the time of the peak is at the time of the extreme return. So there was just a lot of volatility. Probably jumps contribute to a big part of it. Now, what we did also with this model-free high-frequency measures, we can actually separate how much of that volatility came from jumps, okay, in the price level, and that's what you see here with the dashed line. And so you see that yes, indeed, that jump contribution, the jump contribution was high also during the week of the extreme event, but as a ratio of the total realized volatility, actually, it doesn't look like it changed much, which is basically going to show that it just says that jumps trigger also volatility and maybe increase jump intensity. And as a result, when we end in this kind of turbulent period, we have jumps, but then they trigger more jumps, they increase level of volatility, and the whole kind of this kind of self-excitation snowball type of effect. So maybe the answer to my previous question, which was why is jump risk price jump risk why is jump risk priced so much? Maybe the answer to that question is that jump risk doesn't come alone, in a sense that jumps also affect volatility, jump intensity, and that actually can through this self-excitation process can result in big returns and big negative returns over relatively short periods of time. Now, if that is really what's going on here, then I should see a lot of action on the term structure of risk. Okay, and now I have a lot of, because of this recent advances, some of you might know on financial markets, derivative markets, we have a lot of trading on the short end of the term structure. And so we have basically so-called weekly options on the S&P 500 index, which expire Monday, Wednesday, Friday. So every other day you have an expiration option expiring. So, and by the way, probably some of you might know that as of this month, the CBOE is also launching this Tuesday and Thursday expiration date. So basically from this month on, we will have expiration every day of the week. And so basically this is excellent if you're looking at analyze the term structure, the short end of the term structure. And if jumps are really affecting jump intensities and volatilities, that's where we should see this impact showing up clearly. And so now I will show you this just as an illustration. We'll have more to say, of course, about this. And so I went and looked in the data and look at the term structure of risk neutral volatility. And I will be more specific, but you probably know what these risk neutral variance measures are, and also a risk neutral third moment or proxy for risk neutral third moment. So I looked at only at the very short end of the term structure. And so bear in mind when you are analyzing and you're kind of making sense of how big these term structure effects are, that here time to maturity ranges from 4 business days to 7 business days. So this is super short end of the term structure. These horizons here are not like months, it's just days. Okay. And so just to make things easier to compare and to contrast, so I normalized on each subplot, I normalized the levels by the level of the corresponding measure for the short end, which means that they always start at 1, and the level at the end basically shows in what percentage they're higher than the starting point. Okay, and so I look at as an illustration of this term structure effect, I looked at 2 typical days, and there was no cherry picking in this. There's summary statistics in the paper. You will see that this holds more generally. And so on the left side, you see the risk neutral variances, okay? And on the right side, you see the risk neutral third moments. And So the first event, I picked two events. So one is February of 2019, when, if you remember, this was extremely calm period, things were relatively quiet. And then I picked a very turbulent period of March of 2020 during the pandemic, when volatility was really very high. And so what do we see here? Maybe the first, let's just discuss briefly the risk neutral volatility. Things are not surprising. I wouldn't say they are surprising. When volatility is below its unconditional level, the term structure is upward sloping, and when the volatility is above its unconditional level, it's downward sloping. So that's hardly a surprise. It's good to confirm that. Maybe the only thing which, from my point of view, was somewhat surprising was to see the magnitude of basically the slope. For me, it was kind of high. In particular, if you look at this plot here, the top left corner, you see that actually we're talking about in 3 business days, the volatility increased by 35%. So that's that's a big change. And it just goes to show that there are a lot of these short-term volatility shocks with short persistence, which are playing here, and they play a role, and they should probably be accounted for. But other than that, there's nothing really surprising on the left. What is surprising to me, what was surprising to us, was actually the action on the right. And the action on the right is that term structure, but of the third moment of returns. And the first thing is the scale of the change. I mean, if you look at here, we are talking how big those changes are. We are looking at from 4 days to 7 days, basically the risk neutral third moment triples, more than triples, in fact, in value. So that's humongous, that's big, right? It's very, very big. So this is not negligible. I mean, 30%, I thought that 30% was large, but when you look at the third moment, there's actually really, really orders of magnitude kind of bigger differences. And also, it cannot be just a simple mean reversion story, because if you look at the period when volatility was very high, actually the term structure of the third moment was still upward sloping. So it cannot be just that simple story that mean reversions of volatility are driving us, being below or above the starting value. Now, when you think about it, if we're talking about jumps, and in particular symmetry of jump distribution, well, that's exactly the place where you should be looking for. The signal for that should be strongest, which is look at this risk neutral third moments, right? And so that just tells you there's a lot of action happening through the jumps. And the action is basically, we have a word for it, we call it jump leverage, and hence the leverage in the title of this paper, basically meaning that price and volatility co-jump, and positive or rather negative jumps in the price are accompanied by big positive jumps in volatility. And maybe that's something to do and rationalize and explain this pattern. So in a nutshell, what this paper will be doing is trying to rationalize these term structures, or rather trying to extract the information in this term structure, and going to kind of separate or tease out that component of jump risk, which is due to this self-excitation or jump leverage, or whatever you want to call it. So what we will do is just a short summary of the results without kind of a high level overview of this. So what we will do, we will develop this kind of, they are very simple, as you will see. It might sound fancy, but it's really something simple. Model-free expansions of these short-dated options or risk-neutral measures. And what this will allow us is to pin down the compensation for jump risk, where you control for all these time-varying intensities type effects, and then also to get down to that leverage effect, to identify the leverage effect, or the priced leverage effect, I should say, because it will be something under the Q measure. Okay, and we will use both SPX and VIX options, and they will provide independent source of basically a verification of the story which we are trying to tell here. And if I have time, I will tell you probably a little bit about what kind of equilibrium models can generate this type of effects. All right, so I'll just jump straight to kind of giving the setup in which we will work. I'll try to keep notation as minimal as possible to the extent that's possible. And so what are we going to have here? This is just an underlying asset price. For me, this will be the S&P 500 index, and it evolves continuously over time. So we have a sigma t is my usual volatility, and then we have jumps. Mu just counts how many of jumps we had over a given interval, and nu is basically a measure for the expected jump sizes and jump arrival times. People call it jump intensity also. Okay, so obviously this depends on the probability measure, so it's different for P and Q. Right, and the same thing applies for the Brownian motions. They are under P, under Q. So this is just a notation. Pretty much any asset pricing model fits into this framework. So what I'm going to do now is I'm going to be interested in variance risk measures. And what I will do, and variance risk measures computed over short-term intervals, over short horizons, and do a kind of an expansion of these variance risk measures and connect them with the underlying asset risks of the asset price. All right. So we will use two measures of risk neutral, two measures of variance, and the first is probably the more intuitive one. If you are just the second moment of returns, or the second center moment of returns, so it's the risk neutral variance. Okay, and so it's denoted this way, as you see here: t plus capital T. So the capital T is the time horizon, or the time to maturity of the options later on. Okay, and this thing is under Q. Okay. And the second one is one which is probably more popular, which is basically use the first moment of the log returns, and basically by application of Ito's lemma, it will be somehow connected basically to measure a variance. I mean, the first part here is the diffusive component, and so that's exactly what variance is. The second piece, which is due to jumps, is not exactly variance, but I hope you're not intimidated by this notation, but if you just make an expansion around zero of this function here, you will see that the leading term is the second moment of the jumps. And so that's basically, that's why people, I think just people forget about this and ignore this and just interpret it as a variance, but it's not exactly that. Okay, so this is defined over short intervals of time. And now I can, but in my setting, and because of the available option that we have now, I can be thinking of time to maturity being very, very short. And I can be interested in what happens when time to maturity actually goes down to zero. And so what I will introduce here, it's convenient, is just to introduce the spot or the instantaneous risk neutral variance measures, which basically the limit of this risk neutral variance measures over a given interval, but then just basically collapsing the interval to zero. And so what you get in this case, of course, is the spot variance. But there are these two versions of the spot variance, depending on the two risk neutral variance measures. So, by the way, just as an aside here, maybe that wasn't the best choice of notation, but mathematically it looks pretty. So I have the two versions of the variance measures. One is regular V and the other one is script V, okay? So it looks pretty, but so V for variance, okay? But they're slightly different. And in fact, if you look at this difference here between them, that's only due to jumps. And in fact, it's due to approximately the third moment of jumps. And so that's why I'm kind of keep carrying with me these different risk neutral variance measures, because I will explore the gap between them to study the jump risk later on. And this, by the way, has been done in a paper by Du and Kapadia. I think they had something, I think they called it tail index, if I remember right. Okay, so these are, of course, unobservable spot quantities. The spot quantities, and now with their help, now I can do this expansion, okay, of the variance, of the risk neutral variance moments. And the first one is here, and the relevant part is highlighted in red. So this is script V, so think about it VIX, so that's the VIX, okay? And the leading component is this spot risk neutral variance. And the second component depends on the time to maturity, T, okay? So if T is short, obviously, this second piece collapses down to zero, okay? And it's multiplied by what? It's multiplied by something which we call instantaneous drift term, Okay, so that's basically the instantaneous conditional expectation of volatility. Okay, so now if I go back, if I connect here with the plots which we were seeing on the risk neutral variance, they actually make a lot of sense. Like this term here, you will expect it to be positive if we are sitting below the mean level of volatility because of mean reversion, and to be negative in the other case. And so that's basically this slope of the term structure is captured exactly by this term. Now you can continue expanding, and you can allow a little bit for term for curvature here, because, and that's why we keep the term t squared, because like if there's very fast mean reversion, you probably want to keep this term around just to clean or correct for this. So I think that this is not surprising, okay? But what was surprising to us, and this is the key where we will kind of get the information from, is when you look at the second risk neutral moment. So far I showed you the VIX expansion, and you can do the same expansion now for the second risk neutral moment, which is the conditional variance. And if you do this, here's the corresponding piece in red. Again, you get the leading component, or the spot quantity, okay, in red, at the first piece here. And then you have a piece which depends on t, on the time to maturity. And obviously, the shorter the time to maturity, the smaller this piece is. But if you look at its contribution, it has two components. So the first is this mean, or this kind of instantaneous drift or mean effect, okay? So that, which basically controls the mean reversion to volatility. And the second piece is the leverage. And maybe that's intuitive. It wasn't immediately obvious to me when we were doing this decomposition, but it kind of nicely comes out of this, and it's a risk neutral leverage. So that's the risk neutral expectation of the covariance between price and volatility. Okay, and so this is, I define it here more formally. It's a risk neutral leverage. You see this here notation means covariance. Okay, and you're looking at the covariance over that interval of time. Because I'm looking over short intervals of time, really what the leverage is, it's about the spot leverage, kind of the instantaneous piece. But in practice, of course, this will be more like an integral over that short interval of time. And so now, so we have to, just to summarize, we have two expansions. So one is for the usual VIX measure expansion, and the other one is for the second risk neutral moment. And then they look similar, except for here, you also acquire the leverage effect. And as we know, this L is supposed to be negative because price and volatility move in opposite direction empirically. So you're expecting this to be pushing up the term structure, right? To make the slopes more upward sloping. And in reality, the first term here can be positive or negative, and there will be probably cancellations depending where the level of volatility is. But this is great news for us, because I did not need any model to, well, I mean, you do need some regularity type of assumptions, but very little is needed actually to make these expansions. And now just imagine how I'm going to apply this result. Well, I have a lot of short dated options, and I can calculate these risk neutral variance measures over a few time horizons, which are relatively short. And then you can just run at each point in time a regression on a constant, the time to maturity, the time to maturity squared, and then you will probably run out of options, so you will stop there. But it's just, this typically is just enough to capture some potential curvature effects. And what that will do is basically we will pin down the spot variances, but we will also pin down these drift effects here, including the leverage. And so we will have a model-free estimate of the leverage this way. Okay, so now let's see. So once we have this decomposition, so short-term decompositions of the variance risk, we can actually, it's probably nice also just to fix ideas, to make a short-term decompositions of variance risk premia as well. And as you know, the variance risk premia is just the gap in the P and the Q expectations of the variance risk in the future. And I have two versions of this because I have two alternative measures of variance. Now, the same way as I introduced the spot variance, I can also talk about spot or instantaneous variance risk premia, which is due to the instantaneous variance risk. And if you look at this now, it's worth pointing out here that if this wasn't immediately obvious. So if I calculate, this is calculated on the Q. If I calculate this same thing on the P, well, nothing will change with the diffusive term, because by no arbitrage, it should stay the same when we change to equivalent changes of measure. And the only thing which will change is the instantaneous variance of the jumps. And so in other words, anything which is related with this instantaneous variance risk premium should be due to jumps. So, and that's basically, that's really the effect, that's the effect of jumps that is free of this, or it's purged of this effects of the jumps on, you know, mean reversion and jump intensity and effects on volatility and things like that. So that gives you this. And then you can make the same expansion, just like I did for the risk neutral variance moments, where you expand as a function of time to maturity. And the variance risk premium, then we will have the leading term is the instantaneous piece. Then you will have this term structure effects. And then in the case of the first version of the variance risk premium, you will also have the leverage effect contributing to the risk premium. Okay, now I had just to fix ideas, I had a simple example here with a no arbitrage model, the Duffy-Penn-Singleton double jump model, because it kind of probably helps fix ideas. Time is short, so I'm going to skip those slides because it's better to show you what we do and what we get on the data rather than do that now. Okay, in the interest of time. All right, so if we go to the data, what we need is basically to calculate or to compute the risk neutral first moment and the risk neutral second moment of returns or log returns. Now, this is easy, and obviously, so I don't need even to spend time on this. Just the integrals with respect to option prices and the integrals against strike. Okay, and then what we get when we do that, of course, in practice, you have to discretize and Riemann sum approximations of these integrals. So this is standard stuff, and then you will get the stuff with the hat, which is basically our estimator from the data of these risk neutral variances. Okay. Then what we will do, and I already alluded to that, what we will do is we will run at each point on each day, say that we are working at market close on each day, we'll run a regression of the risk neutral variances against time to maturity. Okay, and so we'll have an intercept, a slope, and a term for the quadratic term, which we will just basically, we will control for it, but we will ignore and we will not make use of. Okay, so instantaneous risk neutral variances will be pinned down by the intercepts. Okay, so that's the thing which doesn't depend on the time to maturity. And then the more interesting thing for us probably is the slopes. And basically what we will do, remember, just to remind you, sorry, I'll need to flick back all the way back here to these expansions, that if you look at the slopes here, I have one slope here which depends on this instantaneous drift. And in the second expansion, I have again instantaneous drift and the leverage effect. And so now I just basically will estimate, I have the estimates of the two slopes, okay? And I take the difference of them, or twice the difference of them. And what this will give me is an estimator of the leverage, okay? Plus the instantaneous drift of the gap between the two volatility measures. Now, I'm really after the leverage, not after this guy here. But now a few comments on that. So this thing, the gap between the two risk neutral variance measures is typically small. The leading term is the third moment, and the third moment in levels is typically much smaller than the second moment, where this leverage effect resides on. It's in terms of second moment. So this typically it's a much smaller term. Now, of course, it's not exactly zero, but in the end of the day, what that term is capturing is really the drift term in the jump intensity, and the leverage effect will have something to say about that drift term in the jump intensity. So, in a way, they're actually going in the same direction. So that they're not really that kind of that different things. They're not capturing that so much different things. Now, if, however, we want to get rid of it or try to get rid of it, we can still do something. And basically, what we need for this is a mean reversion in the jump intensity. And so, like most models and empirically supported, this jump intensity is correlated with volatility. And so that means that I can actually get a sense of this mean reversion here by looking at the mean reversion of the two variance measures. And so that way you can actually correct for this. So this is formally what you do. You will just look at the variability of the two variance measures, and you will adjust the second coefficient, the second drift term coefficient, to scale or rescale things. So that's pretty simple, as you can see. And I should say that, so if we are working with the model like the Duffy-Penn-Singleton model that I had on the slides, which I never covered, then actually you will see that essentially does the job, and you perfectly get rid of this piece here. So I think that for practical purposes, we just basically ignore its presence, and it just doesn't really affect any of what we are going to do here. Okay. Now, then we need to, as usual, we will need to confront or contrast these estimators, which are backed out from options, with ones constructed from returns. That's relatively simple because I'm not asking for much, in fact. Realized volatility is just the sum of squared returns, nothing to say here. Realized leverage, well, the only thing is it's a sample covariance between price innovations and volatility innovations, okay? And so now we have our risk neutral variance measures, so that's very easy to just based on this. Essentially think of it here using VIX and the S&P 500 index, and you just calculate the sample covariance, and that's basically your realized leverage estimate. And so we are ready to go with that. I will define two measures. One is the realized instantaneous variance risk premium, and that basically is the gap between our instantaneous variance risk recovered from the option data and the realized volatility. Now, so that thing is, so that obviously is not exactly the risk premium, because risk premium is about gaps in conditional expectations. So what I did effectively, I replaced the conditional expectation under the true probability measure with its realization. I know that when I do that, there is just an extra martingale term, P martingale term pops in, but given how predictable volatility is, you would expect that probability term is not that big. In any case, that term is unpredictable, or the increments of that term rather is unpredictable, so it's really not going to affect much of what I'm going to say here. You can do exactly the same thing. You can do exactly the same thing for the leverage effect. It's just realized leverage risk and the leverage effect estimator. Okay, so here's what you get when you do that. So I have two plots. One is for the volatilities, and the other one is for the leverage. So let me just briefly discuss the one for the volatilities. You might be familiar. I mean, you've probably seen a plot like this, I guess. So the solid line on that figure is the risk neutral variance, and the dashed line is the realized variance risk. Now, what do you see here? Well, I mean, if you start with the financial crisis of 2008, not surprisingly, realized risk spikes up during the crisis. It's above the conditional Q expectation. But then if it quickly, basically, it's taken over by the risk neutral variance, it becomes higher and elevated above the realized variance for a very kind of pronounced period, a kind of a long period of time, maybe more than a year or so. The other thing which is interesting, and so at least to me, because I haven't looked at more recent data, the pandemic had a big impact. And you can see this kind of spike. It's relative. And by the way, just one clarification here. What I'm really plotting is essentially spot variance measures. And because of mean reversion effects, if you look at a 1 month horizon, the mean reversion will kind of attenuate a lot of these spikes, and it will make them much smaller in magnitude. But when you go and correct for these term structure effects, you see that actually the spot variance effects are much bigger. It's almost like the pandemic had a much bigger impact on the level of the variance. Now, you can do the same thing. As I said, now we can look at the leverage. And so this is the bottom panel here. So what you see is two time series. One is the realized leverage, basically covariance between price and variance innovations. And then I say also the risk neutral leverage, which I backed out from that kind of difference in the term structure of the two types of volatility measures that we work with. And something similar happens in 2008. The realized leverage spikes up, and then basically the risk neutral leverage catches up with it and kind of overtakes it. Okay, but then if you look at the financial, so if you look at 2020, the effect on the leverage is way higher than you see on the variance. In fact, here we had to truncate that plot so that it kind of looks nice, otherwise it's just too stretched the plot. But the realized leverage risk was humongous during that period of time, and much higher scale, much higher level than what you saw in the financial crisis of 2008. If you're just looking at volatilities probably and VIXs, you probably wouldn't see that much difference between the two. The risk neutral leverage spikes up as well, but but nevertheless, it's still it's just the realized one which really kind of stands out on that figure. The other thing which is also noticeable is that the February 2018, when there was this blow up of volatility related funds, ETFs, is just very noticeable also on the leverage plot. If you look at some, let's just look at a few summary statistics here, just to get a sense of the magnitudes of what we are discovering here. I just use quantiles because these are robust statistics, and given how many outliers you see in the data, I think that's kind of a more sensible way to kind of analyze what's happening in the data. And so you can look at, first we can look at, there's 3 panels to this table. One is about volatility, the second one is about third moment, and the third one is about the leverage. So if you look at the volatilities, what I did is I computed risk neutral volatility, or risk neutral variance, sorry, on using the shortest available tenor, okay? Then I used the longest available tenor within a month and a half, okay? So longest tenor here doesn't mean like 2 years, so it just means it's still short, but it's like a month and a half, okay? And then I report here my estimate of the spot variance, risk neutral variance, and also the realized volatility, which is really something about P. And let's just focus on the medians to compare. What do you see when you look at the term? The term structure does have an effect on all of these estimates. And if you look at the spot, once we correct for these term structure effects, you see that actually you reduce significantly your estimate of the risk neutral variance. And remember, like it's tempting when you're looking over short intervals of time. You compare risk neutral variance with the realized variance, and you just attribute all of this to jumps. Well, in fact, there's a big part which is coming from this time mean reversion effects. It's actually the compensation for jumps gets reduced. It's still large because, like if you look at this gap here, it's still non-trivial, but it's nearly not as extreme as one would be led to believe if you just use like a monthly options. And actually, myself has been doing this in some of my earlier work just because there was not much data at the time, in the earlier periods. Now, we can also look at the same analysis. Now we can do the same comparisons here, but now we can look at the third moments. Okay, and the third moments. So the reason why you see this multiple of 3 is that this is really, when you look at this the difference between the two risk neutral variances, you multiply it by 3, and then you get approximately the third moment of the jump risk, essentially. Look at again at the medians, the effects are massive of the term structure. Basically, if I go from the short to the long tenor, well, again, everything is relative here, the estimate of the risk neutral skewness of the jumps doubles, okay? And if I correct for these term structure effects, I mean, it becomes really modest. It's still there, but it's modest, okay? Yeah, so where is the skewness going? I mean, it's not evaporating, obviously. It goes into the leverage effect. And now you can see here, if you look at realized leverage versus risk neutral leverage, you compare the medians, the gap is really big, really, really big. And bear in mind that, realized leverage is not a time series. Like if you look at this series here, time series here, the dashed line is actually very spiky, particularly during the period of the financial crisis. So To summarize, what that evidence seems to suggest is that yes, price jump risk is there, but price jump risk also comes together with volatility jump risk, and the two are strongly negatively correlated. And that seems to be actually priced heavily by investors. The easiest way to see it is by looking at this kind of term structures of the various risk neutral measures, and you can separate or tease out these different effects. Now, if that's really what's happening, I should see that compensation for, say, changes or shocks to jump intensity or shocks to volatility are priced in as well. Now, if I want to look at that, I need to look at basically these drift terms here. And I'm sorry, again, I have to flip back, but I have to, well, all the way back to where this thing first popped up. So basically these drift terms here. The unconditional, if there was no compensation for shocks to volatility, then so basically Q is equal to P, the unconditional expectation of this thing is 0, okay? On average, the drift is 0. So a positive number means that there is a compensation for this risk. So I can go and now calculate the time series of this. So I'll skip in the interest of this. So basically calculate the average slope, and you will indeed see that it's positive, which is consistent with that story. Not only this, but what we find actually quite interesting is now you can redo the same procedure, which I did now, but you can push it forward. What I mean by this is so far I was using short-dated options from today until, let's say, a week or a week and a half, like into the, I think we look at 10 days into the 10 business days in the future, which is basically 2 weeks. But now I can say, okay, now I have a term, short end of term structure is very rich. I have a lot of maturities, and I can look at options which expire in 2 weeks and shortly after, and redo exactly the same analysis which I did right now. And what I can do that way, when I look at the term structures, the slope effects, I can back out this risk neutral, you see this risk neutral forward drift, I call it risk, I don't know, but that's the good name for it. But anyways, we call it this way, is the conditional expectation of the forward drift, of the drift in the future. Now, what should we expect? I mean, if the compensation really to shocks to volatility on the long end, then we should expect actually this to be equally big, equally large, like what we recover on the short end. But that's not what you see. If you look at these estimates of the slope, they actually really go down, and they go down very fast, I would say, actually surprisingly fast. So that basically is consistent with the story, a story in which there are indeed jumps arrive in the price, they arrive together, they trigger jumps in volatility, they trigger jumps in jump intensity. And this is the type of risk which gets compensated. It's relatively short-lived. It doesn't need to be short-lived effect, but that's what the data seems to suggest. And that kind of self-excitation kind of spikes up really around this 2-3 week horizon over this very short period of time, and then it kind of dies out. Okay. Now, I have probably just a few minutes left, so 5 minutes or so. So now this was all evidence from S&P 500 options, and it's impressive that actually you can back out the leverage in a model-free way without any use of anything else, just the option data on the S&P. But now, if really what's happening here is this leverage effect, which is the channel which contributes to that surprisingly high levels of the compensation for jump risk, then what I should see is that should actually be reflected very clearly also in VIX options. Because VIX options, what are VIX options? And just this is what I will do now in the remaining few minutes or so. What are VIX options? VIX options will be options, well, there's options on options, right? But options on the level of the VIX index, which is written here in my notation, right? This is, in my notation, this is the VIX, is the script V over 1 month, okay? And you square root it, okay? That's how the contract is written, annualized volatility in annualized volatility units. So that is options on the VIX index. Now, the VIX, so VIX index is approximately the conditional, the spot variance, not exactly, of course, but for what we are going to do, this is just enough, that connection, okay? And so what I should see is I can now go and back out the pricing of jump risk in the VIX series, okay? The pricing of the jump risk in the VIX series. But now here we have to be careful because I'm really not after identifying the fact that jumps are in the VIX, or which they clearly are, or that rather the jump risk is priced. I actually have a more specific message. It's that this, positive jumps in the VIX are bad events and they require risk premium, and vice versa for the negative volatility jumps. So in other words, what I'm trying to say is I'm not going to just do calculate risk neutral vol, which is basically the variance of variance. But what I'll be really after is the asymmetry. Okay. And so in particular, I just said I will not compute vol, but the intermediary step is actually to compute vol. And so that's why it's VV for volatility of volatility. But all it's doing is just basically replicating what I did with the S&P 500 options, meaning risk neutral variance here, and then basically the analog of the VIX on the VIX options. Okay. And these are the ones with the script V. Okay, and then, now I can look at the difference between them, okay? And if I look at the difference between them, it's going to approximately, and that's what really matters here, this bottom part here, it's going to approximately capture the third moment of the jumps in the VIX, okay? And so third moment is, of course, captures, you see the asymmetry, it's exactly what I wanted, and that will be exactly what I want, and that will be enough for basically what I do here. So in other words, what I will do, I will redo what I did with SPX options. I will look at a few times to maturity, run these linear regressions, back out now only the intercept term, because that's all I care about here, okay? And look at the difference in the intercepts of the two regressions for the two different volatility measures. And that will basically give me this risk neutral, measure of the risk neutral variance. Now, I can do the same thing as I did again with S&P 500 data, and look at the realized counterparts of this. And luckily, we have easily accessible these days high frequency VIX option data, so I don't need to do much. And I can calculate the realized vol of vol, based on this high frequency VIX data. Now, I don't know whether Torben is in the audience or not, but I know that he will be unhappy if I just say that I'm just plainly using this high frequency VIX option data. And it is true that actually there are some issues with the high frequency VIX option data. There are a lot of these spikes which are absolutely artificial, and we just apply basic filters to clean for those, and so that we are not affected by this type, or minimize the effect of this rather. I don't know. So that should be, I think, relatively reasonable. Okay, and so I will just basically look at then these two different realized variance measures, and what that will give me, it will give me a proxy for that kind of skewness or asymmetry, or third moment rather, of the VIX returns. Now, when you do that, here's just a summary of the results. First off, if you do just from the realizations of the VIX returns, you will see something which I think other people have noticed too. And this is just basically the VIX distribution looks nearly symmetric. Okay, meaning at least when you look at the extremes, it's kind of that skewness is not that far from zero. But if you look at the Q jump distribution backed out from the options on the VIX index, then you can actually see a very, very significant right skew, right? Because here the skew is, like the fear is on the positive jumps, not the negative jumps. And basically, which is just showing that shocks to the conditional state variables in the model are priced. Okay, it's not just instantaneous risk which gets priced. Shocks to these conditional state variables gets priced. Now, I think I'm around about, this is probably the place which I will finish. Just only thing I will say that, like, of course, you would like to now just analyze a little bit, try to understand better, what kind of equilibrium mechanisms can be in play that generate this. And actually, luckily, there are a number of models which try to fit or use equilibrium models to fit to the option data. You can nicely discriminate different stories actually about on that dimension of whether they can actually generate this jump leverage risk. But in the interest of time, I'll stop here, and maybe I can talk if there are questions about this. So Christian, is that right? Is that my correct interpretation? I'm done with my time, right? That's where I should stop.
Yeah, well, if you need a couple minutes more, don't hesitate. Tim has made my life very easy in the managing of the chat. So
right,
it's up to you.
I rather actually take questions, and I can talk about the equilibrium specifications if there is interest about that. So that kind of, I'm okay with actually answering questions now.
Perfect. Let's open the floor then. Is anyone ready to jump in? David.
Yes, just one thought on this. It's the overall approach of using Taylor expansions and approximating as you go to zero maturity reminds me a lot of the Aitzahalia, Lee, and Lee approach of doing Taylor expansions. Now they're focused more upon the volatility smile and smirk extrapolated to the zero maturity. But certainly one of the things they pull off there is the direct leverage and the diffusive component. And I'm wondering to what extent you could expand more. From my perception, jump leverage is definitely important, but the regular leverage is also there. And I'm wondering what your approach has to say about that.
Okay, excellent question. Thank you, David. First, nice to see you. I don't think I have seen you in person in a while. So, okay. So first about, yeah, that's a good point about the expansions. Now, okay, so well, I can say a few things about that, more technical and more about the probably economics, which maybe I should spend more time on the second one. But let me say on the technical side, yes. So basically, if I remember right, what that paper was doing expansions of Black-Scholes implied vols. This in general is a very difficult task, and you do require a lot of assumptions actually for making this thing work. In fact, I do think that volatility jumps were ruled out in their setup just because this is really difficult to do. But why is that? Because they do because they're expanding option prices. What we are expanding here are risk neutral measures where actually I aggregated the option into option portfolios. This is a much easier object to analyze. And pretty much here, I don't need any assumption. I don't need assumptions that jumps are present, not present, jump intensity, jumps, finite, infinite activity, finite variation, nothing of that. Because, I mean, the result is pretty intuitive what this thing is happening. And it's just none of this is going to show up. And basically, and I think that's the beauty of it. But if you want to expand the whole option surface, then clearly it's, from my point of view, you will need a lot of assumptions. I don't think you can get away. So that's not a criticism of that paper. It's just stating the obvious thing that for this type of expansions, you need a lot more work. And the other thing, and the other thing which I think they did expansions around zero, around the money. That's not where you want to see the level. Well, the jumps, right? The jumps were more acting on the tails. And so that's basically, this is a nutshell, is the big difference between those two approaches. As about the diffusive leverage, yeah, now, so that's true. So I should be a little bit more careful here. And so what we did is that what you get here is an estimate, the risk, so this, what LQ, which is our leverage, is actually an estimate of the total leverage, right? It's not just the jump part. But if I'm looking at the leverage of a very short interval of time, just like with the price jumps, the diffusive part doesn't play a role. If we're looking at I'm looking at very short to maturity options, and so that effect of the diffusive leverage is not going to be that, in relative terms, that dominant. Now, probably more, I think it's an interesting question to think how to actually separate the two effects. What I know from my previous work is that actually you can, from the option data, you can separately estimate the diffusive leverage, and maybe that's the next thing to do, and just to see how those two things play out. But my guess is that you will ask much more from the term structure to identify separately those effects. But these are obviously good, great questions. So thanks you. So that's kind of food for thought.
So since everybody seems shy, you kind of opened the door to talking about equilibrium implications. Can you share your thoughts on how this pricing of the leverage occurs?
Okay. So maybe I can do that briefly. So the models we looked at, they're all kind of consumption based and representative agent models. And so I'm just giving a few as just an idea of what might be happening or what can potentially generate or account for these effects. By no means, I don't think this is an exclusive list of models, and probably all sorts of other features I think can be accounted for in the model just to make it realistic. But with that caveat in mind, I can just give you a few just a comparison of a few models which I know people have used here recently, and I have seen work published, and just to understand what's happening here. Okay, so if you take a nice actually model, a rare disaster model with time varying disaster risk, well, disaster basically in this model maps into consumption jumps. Now, I will leave aside, I will just really focus qualitatively in nature and not about the size and how you actually calibrate these models and how big the size of these jumps can be and all these kinds of things. I'm really not making any claims on this, and and whether how close we can get this to match consumption data. But this is nevertheless, it's a very realistic model. We have basically, there are big jumps in consumption, big or small jumps in consumption. They generate, they arrive at the time varying probability of this disaster risk. And in that kind of model, with an absence-in preferences, right, relatively general model, in that model, the price, the equilibrium price will have jumps, but volatility will not have jumps. Okay, so you just have consumption growth jumps, and nothing happens in the volatility. And so they're not going to generate this kind of second channel of the the leverage effect, which we are really after. Now you can get an alternative model, which is basically the habit formation type model in continuous time. And so you can look at a habit formation where habit formation is based on past consumption. And so if you have these consumption jumps, now that habit formation will get shocks or jumps to risk aversion, and that will map both into jumps into the price, but also in the volatility level. And so that, at least qualitatively, this type of model can actually generate that channels through the risk aversion will generate this connection, and both price and variance risk will be price and variance will exhibit jumps, and they will be exactly priced. Not only that they will exhibit jumps, but they will go again in the opposite direction. So they will exhibit this leverage effect that we are after. And the third one, and I will really not kind of spend more on this, is just you can now, I mean, I a little bit worked through the preference channel. So I went to this habit formation. What you can do is also you can generalize the consumption dynamics. And I think that this is something that Bjorn and Racker had in his recent paper. Basically, you think of volatility, consumption volatility jumping, and then that endogenously will generate also jumps in the price level. And from there on, you will have this type of connection also happening. So what is the, I mean, these of course are just a set of, I mean, if you are really serious about it, you have to go and calibrate them and really test them on their connection, how they can jointly explain consumption dynamics and asset price dynamics. And we're not going to do that. We're not thinking of doing that, but but just goes kind of on a qualitative nature, suggests this type of two possible mechanisms. You either have to generalize this, introduce state variables which get this kind of big shocks, like volatility and jump intensity, or of the primitives of the consumption in this case, or shocks to consumption in some form. And maybe this is kind of a high level thing. You can specify intermediacy constraints and all those kinds of things you can add to the picture to just basically generate that wedge. So I don't want to spend more time on the equilibrium models because we're not calibrating and doing any of this thing here. So
no, I understand. It's just well, egoistically, it's something that I very much like to look at, and also I was kind of so Claudia made a point about, you know, the connection in the chat. She made a point about the connection between jumps and volatility potentially being due to illiquidity in the market, right? And that would be a completely different channel than going through.
Right. So I don't, but I'm not quite sure. I mean, yeah, maybe that is true. I mean, I don't know how. So yeah, we're really asking. I mean, liquidity is kind of an easy way out explaining many of the phenomena, but I just, yeah, I don't. I mean, we're talking here a little bit kind of, well, I mean, I don't know how you believe about liquidity. That liquidity persists over days and stuff, but I mean, it seemed to me that what we saw in 2020, I mean, markets perfectly well. There were a few opening issues with the VIX as far as I know, but after that, once the market opened, things were operating normally, I think. So yeah, I mean, but I don't rule out this is possible kind of a channel through which this is generated. Yeah. I think she is trying to, Claudia, maybe you can, yeah, you can say it because.
Yes, thank you, Victor. It's a very interesting paper, so super interesting, and it's related to some of the work that I've done. So practically, yes, you're right. Liquidity. So what I'm thinking about is times when there are short liquidity gaps in the market, just when the circuit breakers are triggered. So what I found in my work is that when you have such a pretty large number of the constituents in the S&P 500 halting because the circuit breakers get triggered due to illiquidity shocks, then I see a jump in the spider. So these are short liquidity gaps.
Right. So actually, I mean, by the way, I mean, related to you're bringing something I went over, I just passed through quickly. This is a snapshot of a few of those events. I don't know whether it's visible very well, but I mean, so I looked at a few of these episodes in the data when we had like weeks with 10% or more drops in the market index, level the market index, and we plot against also the leverage effect. And you can see the leverage effect is going around a lot, reacting a lot. I mean, and the price when there were periods of market circuit breaker triggered in, actually only in 2020, in fact. And so these periods are kind of blanked out of here because I mean, obvious reasons. I think we also, the other thing I should say is that we chop out the first 5 minutes of the data, the last 5 minutes of the data. We were super cautious with this sort of, with those sort of things, but you do see a lot of variation in those leverage effect estimates.
Right, and the point that I was making is not going to apply to 2008 or 2011 because the circuit breakers were, the single stock circuit breakers were implemented after the flash crash of 2010. So yeah.
Right. So there was, but 2020 we had 4 circuit breakers triggered actually. So I know that.
I'm sorry. Yeah, you are talking about market-wide circuit breakers. Yes.
No, yeah. So I'm sorry. I didn't clarify. Yeah, market-wide.
Yeah. I'm talking about stock level circuit breakers here.
Okay. Yeah.
So when individual stocks in the S&P 500 stop trading, that's when I see the jumps in the SPY. That's right. That's what I was referring to, not market wide. But these are also times when there is a large market illiquidity shock as well. And we can talk more about this.
Okay.
Thank you.
So I did not actually pay attention to the chat room, but was there?
I think Tim addressed pretty much everything.
Oh, okay. Oh, Tim was taking care of. Oh, wow.
Yeah, he took very good care of it. There's a last kind of comment / question regarding what you could do with individual stocks. I guess the panel of option is a bit less rich, I guess. So
we just have to wait for a few years, I guess. So no, but actually it is, I mean, a lot of trading now with individual name options. So I think that it's not that hopeless that there are things, but obviously, I mean, you don't have options expiring every other day or every day. So that thing, yeah, I wouldn't push. I mean, we were just talking with Tim the other day that we were trying to do this thing many years ago with individual name options, and then we kind of give up because you had like 2-3 options per. For a stock like IBM. Now things have changed now, but still, not as much on the maturity domain. So